In a single day of trading, StakeStone moved from a few cents to nearly 50 cents, fueled by nearly $500 million in volume. That momentum continued for months, eventually pushing the token to a peak of $1.74 in April of 2026. But that high was short-lived. Today, the token has retracted 96% from its peak, currently trading at approximately 5.5 cents. A decline of this magnitude usually signals a project's end, but the technical utility behind the token requires us to look at whether this is a collapse of the project itself or a temporary imbalance in the market. StakeStone operates as a decentralized finance infrastructure built on Ethereum, specifically designed with an omnichain architecture that allows it to function across several blockchains simultaneously. This enables liquid staking. When you lock ETH or BTC into the protocol, you aren't just letting it sit there. The system gives you a secondary liquid token that represents your stake, which you can use to interact with other profit-generating protocols. This creates a double yield scenario. Your original assets earn staking rewards, while your liquid tokens are deployed elsewhere in the market, allowing your capital to remain active while it earns. The project was founded in 2023 by Charles K. and carries significant institutional weight through backing from Binance's YZi Labs. The STO token functions as the governance layer, giving holders a direct vote on how the network and its cross-chain infrastructure are managed. By integrating BTC and ETH liquid staking into a single multi-chain environment, the project provides a specific utility that attracted major capital. This functionality provided the initial logical basis for the project's early valuation. However, the performance of the STO token is currently constrained by its own supply structure. There is a hard cap of 1 billion tokens. Of that billion, only about 225 million are currently on the market. That means only 22.5% of the total supply is actually circulating. This pie chart illustrates the massive overhang. With no burn mechanism, 77.5% of the supply is locked. But that release happens today. $18 million worth of STO is unlocking, adding 9.5% to the circulating pool. This volume of new tokens hitting the market creates immediate sell pressure. It effectively dilutes the value of the tokens already in circulation, making it difficult for the price to sustain any upward movement. The current conflict is between the project's utility as a DeFi tool and a distribution schedule that is aggressively increasing the supply of tokens. Trading at roughly 5.7 cents, the market sentiment around the token is currently at its lowest point since the initial surge. On the chart, the key level to watch is the 10-cent psychological resistance. This is the horizontal line where buyers previously failed to maintain control. Before any recovery can be confirmed, the price must reclaim and hold that 10-cent level. Until it does, any price increases are likely to be met with more selling. Regardless of the institutional backing, the technical chart remains bearish as long as the price stays below that 10-cent threshold. The cross-chain liquid staking infrastructure provides a functional layer for DeFi, but the immediate dilution risk from the tokenomics creates a barrier that utility cannot solve on its own. For now, the most logical approach is to keep STO on a watch list. It is safer to wait on the sidelines until the market has fully absorbed this $18 million unlock and the price action shows signs of stabilization. For those who choose to trade this volatility, STO is available on Binance and Bybit or through Uniswap for decentralized users. However, given the supply pressure, using tight stop losses is essential. Remember that this analysis is for educational purposes and is not financial advice. Market conditions can change rapidly, so perform your own research and assess your own risk. Do you believe the liquid staking utility will eventually outweigh the token dilution? Share your thoughts in the comments and subscribe for more weekly breakdowns of the crypto market.